showing you each week the simple decisions that you can make in your investment research phase to give you the best opportunity to build a growing and successful portfolio. If you like what I'm doing, guys, please feel free to hit the subscribe button. Every subscription is very much appreciated. Or leave a comment in the comment section if you would like me to have a look at any of the shares and stocks that you've been looking at to give my simple research opinion on. Quickly want to dial back to a share that I recommended to look at as part of your research. On the 22nd of May, I released a video about the ME Group International PLC, which you can see on the screen. So guys, since this video released on the 22nd of May, which we can see here, the share price was 166. The share price has gone up to £1.83 per share, which is an over a 10% growth in a little over a week, which is a great return, and beat the banks, as they say. So anyone who watched that video and took on board my research and decided to follow through with a share purchase, good on you. I don't know what your investment strategy is, but being 11% up after 9 days is not a bad position to be in. So I wish you all the best, and whether you see it all on the way up or on the way down, as we never know what's going to happen. But yeah, good luck to you. And for those of you who didn't watch that video and didn't get involved with it, and are probably asking the question, is this going to continue to keep going up? I would say watch the video, look at the fundamentals of the business itself, keep it simple in your research approach, and go through it stage by stage, as what I did on that in my first video, which I will link in this video, and make your own decision as to whether you think it's a viable company for your portfolio and your needs. What I would say is that it has broken out of its 52-week high, which is 1.82, I believe. So we don't know where this stock can go. I still personally think it might be slightly undervalued, but again, the research you need to do is key, and and then make a decision as to where that fits into your portfolio and your strategy. If you're looking at holding it long term, looking for dividend returns, or looking for a quick gain, that's entirely up to you, but the research is in that video, guys. So if you want to continue receiving notifications when I recommend a stock, or at least show you in my research what stocks I'm looking at a bit more closely, please do subscribe. Every subscription is appreciated, guys. This video is not about my successful research into the other one, because not every video will pick a winner, if you like, because what I'm doing is giving you the simple tools to use to qualify your investment decisions. And as you all know, you can do all the research, the best research in the world, with the best will in the world, and stock prices can still go down. So I'm not selling you a magic potion to picking a winner every time. I think it's just important to highlight that good research and clear investment strategies and simple investment decisions can lead to success stories, and will more likely lead you to success stories than just listening to punts from other YouTubers, or from just taking a gamble from what you might hear on the off cuff on the news or on a website, someone tipping it. Fundamental research is the way to go about getting a successful portfolio together. And if you think that that's not for you and that's a boring way to go about it, then these videos aren't for you. What I would say is that if you find building a successful portfolio that's making you money boring, then we differ quite slightly. And if you're in it for the gamble and the ride and the thrill, then again, these videos are not for you, because I'm not in the habit of losing money. I don't like it, and I appreciate it as part and parcel of investment, but I like to do everything possible to maximise my returns and make the right decisions. So enough preaching. I love to preach, don't I? Let's talk about the next company that's on my watch list for sure. You may have already heard of it. It's called Pan African Resources. And as you can see here, it engages in the mining, extraction and production and sale of gold in South Africa. It's listed on the AIM, which is a subset of the London Stock Exchange, particularly in the growth sector of companies. It's looking like a company with some good fundamentals and some little interesting pockets of information that you can pick up from the balance sheet and its use of debt, etc., and its dividend distribution, which will makes it part of my watch list for sure. As always, I like to start with a little bit of a review of the website. I've done a bit of digging around, and the company has a lot going on. It's aiming for the future. It's got a very environmental and sort of landscaped philosophy, which is great for any potential investors with a sort of ethical or environmental underpin to their portfolio. It's got a lot of mining going on in South Africa. I said it's got 3 main mines which extract gold, which you can sort of go into here, and it can show you about. You can have a read about what it's doing, how it's shaping itself to protect itself, future-proof itself, if you like. But I think generally, what I like to have a look around for the website on is this a company that is hiding anything, or is there any bad press about it, or what is it doing, what has it been doing today, and what is it planning to do in the future? And you can really start to get a feel for that from this website. So spend some time on that if you want to, but I've done it, and it's to me it's a green flag, that website. It gives you a lot of good information and gives you a good feel for the Pan-African resources as a company. My first test, as you will be aware if you've watched the other videos, is what is the market cap of this company? What is this company valued at? As you can see here, the market values the company at 489.7 million. I like to keep the companies I look at in my portfolio and build into my portfolios, but somewhere between 50 million and a billion, or 1.1 billion roughly. I'll explain why, and that's because anything above 1.1 billion I think is harder to receive or extract those bigger gains and ride those higher highs than companies sort of fall below that line. That's not strictly always true. That's just the simple rule I always keep to. Generally, for a company that's above a billion in valuation, you sort of do see growth, but you don't quite see it in the same rate at times. If you pick companies below that, it's quicker, in my experience, to experience growth in the companies that sit in that range. Anything below 50 million, around 50, 100 million, something like that, you can struggle with liquidity in the market. And trust me, guys, you don't want to be holding a company whose share price is plummeting and you don't have the liquidity to get out of that and trade out and sell your shares, because you are essentially holding a knife and you will ride it all the way down, or at least further down than you wish. And I'm speaking from experience on that, and that is why the bottom parameter of my market cap has been set at around 50 million. So as you can see, that fits within that, so that's a good first tick for the company. Let's go down to see how healthy the company is by taking a look at its balance sheet. We can see here that Simply Wall Street likes it. I don't tend to pay too much attention to Simply Wall Street's criteria, although I absolutely love the information it gives you. Its tests aren't quite the same as what I'm looking at, but it is a good indication that there's a good healthy position behind this company. So let's scroll down a bit and go to the financial position analysis, which is essentially a very simplified balance sheet. What we can see here is that in the short term, the company just about surpasses its short-term assets compared to its short-term liabilities. Short-term assets such as cash, short-term liabilities such as creditors, things like that, which we can go into a bit further below. On the other side, we can see the long-term position part of the balance sheet, which shows that the company has 510 million pounds worth of long-term assets compared to its 186 million of long-term liabilities. So what we can see here is quite succinctly summarised, nicely summarised below, that short-term assets exceed short-term liabilities, which is good. What we do have is a little bit of a net debt position here, which I don't think we've had on the other two, because I generally like the positive balance sheets. So net debt is how much debt, long-term debt a company has, or long-term liabilities a company has in relation to its short-term assets. So as we see here, short-term assets are 62 million, long-term liabilities are 186.68 million. So we can see there's sort of a net debt position there of around 124 million pounds or something like that. So that's a slight concern, in that long-term liabilities are usually long-term debts in terms of loans, which can attract interest rates, which can leave a company a little bit strapped for cash if interest rates fluctuate, and that's why you ideally want a higher short-term assets than long-term liabilities to nicely cover any interest payments and to stop the company being a risk. So whilst this in first instance is a healthy balance sheet, there are some little bits of nuances that we've just got into there which show you that there could be a little bit of concern. When it comes to net debt, my general rule of thumb is that there's a company with no more than 3 times net debt compared to its pre-tax profit for the current year. So if we've got 124 million pounds net debt, which we've just gone through, is that 3 times more than what the company's earning? So let's just hold that in our minds when we move to the P&L for the year. Let's just scroll down here. These are interesting. This is just the balance sheet in a different format, which shows you again the debt held by the company is around 89.8 million. There are other long-term liabilities on that. So as you can see, nearly 90 million of the long-term liabilities is made up, or the liabilities made up by debt position. Then you've got physical assets, which we would expect from a mining company, and then you have, let's see what this inventory is, around 11 million, receivables around 19, and cash and short-term investments 31.3, which again is why you want to take note of what the most liquid part of a company's balance sheet is, because if interest rates swing dramatically, it may be forced to stump up a lot of cash to pay for its debt, and if it hasn't got that those liquid assets available, it can struggle, and cash flow can be quite quickly impacted and result in some trouble for the company. Let's take a sip of my tea. So let's go back to the performance of the company. Simply Wall Street doesn't lay it out in the way that my research takes place, so that's why I jump around a little bit. But if you remember what we were saying about the net debt position of around 124.8, let's have a look at what the company's doing, what it's been doing, and let's see what it's making a year. So if we go to this section, the revenue and expenses breakdown, this is a very fancy looking P&L. For any accountant out there, it's never quite so colourful and flowy. It's usually quite a boring little list from turnover down through gross profit through to net profit in a list type format. This is colourful, and it makes it easier for me to understand actually, and it keeps it quite simple because it breaks down the revenue strands. So as you can see, it's almost 50-50 split between 2 of the mines, and then you've got the agricultural projects bringing in a little bit of revenue there. That comes through to a cost of sales after revenue, which is deducted from revenue to give you a gross profit of 127.48 million. Then you've got your admin expenses, which form the bottom half of the P&L, if you like, which are trading, non-capital expenditure, as it would be in the P&L, that come off to give you your net profit of 74.65 million. So if we just stop there, the profit of 74.65 million in the year, that is, say 75, let's call it 75 million, 150, 225 would be 3 times that. That easily surpasses the net debt position of the company, which, as you can remember, if you can remember, was 124 million pounds. So why is that important? that just reassures me that if anything happens in terms of needing access to cash quickly, that the company's earnings is available there, and it might need to tweak its dividends, distributions and things, but there's money coming in after expenses that can cover the debt position. So it kind of offsets the risk, the small risk that was highlighted in the balance sheet. So let's go down to the history, because as you'll know, I like to see if the revenue is growing. So if we see here, the company back in 2013 reported revenue of £202 million. This goes up over the years, and then you start to see a little bit of a decline down into 2018, where it hits a low of around 112.5 million. And then from that date on, it starts to grow, and we can see that in the last 6 years, it's made a growth from 112.5 to the latest point in time, which is 359. So it's over trebled its revenue, which is great to see. Whilst it's interesting to understand what's gone on before it, I think the passage of time that passed there, and with COVID in between, you can almost not forget it, because it's worth knowing maybe what's happened there, or digging into what's happened there. I personally am quite happy with a 6-year window that's shown growth and revenue. To not be a major red flag. I don't think you need to, in my mind, overcomplicate it. So if we transfer that to earnings, the company has stayed relatively stable in earnings. If you look at the line, it's kind of dipped and ebbed and flowed with revenues, as you'd expect. Flows through, dips in 2018, where it hits lows of 15.589, 10.7 profit margin, and then all the way to 74 million. So again, I wouldn't worry too much, because the passage of time is so long, and it looks like there's been a turnaround in 2018, which is a long enough period ago to kind of have a little bit of confidence that the company is moving forwards, and Simply Wall Street agrees with me there. So once we've had a look at the market cap and the debt position, or the balance sheet, and the profits, all of which are not perfect, but we've had a look at it and we've kept our decisions simple on it, and we can see revenue's growing, earnings is growing, and the balance sheet is positive, with this slight caveat of the net debt, but there are earnings that cover it. So I always say never buy a company that's not yet got any profit, but whilst that might sound obvious when you say it out loud, there are a lot of high growth new age companies that say are in the hydrogen sphere, or environmental sphere, that are getting grants in and not actually producing profits but are promising big things. My advice is to stay away from those. Let's go to the fundamentals, guys. What are the graphs telling you? What are all these pretty colors telling you? Is there money being made? Because if there's money being made there, there's money to be made for us. So next, I like to have a look at the dividend position. Now, dividends are an important part of your research, because it shows how the company is distributing its profits that it's making. So generally, in the perfect world, if you've got a smooth line increasing in earnings, you would like to see a smooth line increasing in dividends, but not too extensive to the point where it might put pressure on the cash flow of the business. So if we just pull these out, we can see here that dividend payments are made. These are the amounts per share. You can see in the numbers 0.0813, and then they start to drop, because we know that happens around the 2018 mark, and then they start to grow. But for me, it's not the worst dividends distribution in the world, but keeping it simple, it's not filling me with massive amounts of confidence that the dividends have been so sporadic. So that, to me, is a red sort of mark against this company on the dividends stage, and that's just summarised by the annual amount with this purple line here. Whilst it's gone up at this stage, there have been ups and downs, similar to the revenue around 2018, but it's something to worry about. In my mind, it doesn't fill me with massive confidence in that section. So let's keep moving on. because it's not going to fully deter us. But let's go to the valuation of the company. Now, I really place quite a lot of weight on a company's price earnings ratio, because price earning ratio tells you how much an investor is willing to pay for each pound of a company's profit. So it's calculated by dividing the stock price by the earnings per share. So with that, you kind of get an idea. It spits you out a number that can either be a high PE ratio, which means a stock might be quite expensive compared from its profits per share to what it's actually worth, or what conversely a low PE could indicate that the company is actually earning quite a lot of money and the market cap's still quite low, so it could indicate that it's a bargain. Anyone who watched my previous video about Supreme PLC will know that I like to stick to a range between 12 and 25 for PE ratio. Anything that's above 25 I like to steer clear of, because I think it's too expensive for what it does, and the market might be getting a little bit ahead of itself or already piled on in terms of gains, and I just don't see enough growth opportunity or profit opportunity for me with anything above 25. I like to go around 10 to 12 at the bottom end. This is purely because around that stage I think is enough buzz around a stock for the market to be anticipating some growth, but not so low that there might be some red flags on the company. And I think anyone who watched the Supreme video, when we did a bit of digging in, and there was some political landscapes behind the stock price, which fed into its low PE ratio. Again, this company's PE ratio is 8.4. So it's only a little bit below 10, but still 8.4, so it is below it. So is this being completely overlooked by the market? Usually unlikely. So if, it may well be. It's not always the case that the market is always first before you, but you just have to be wary when you see a PE ratio of under 10 or 12, because there could be something hidden. And going back to the previous sections, I think that ties in and transpires from the balance sheet, the net debt position. I think there might be some worry from the market about that, and the fluctuating interest rates across not just the UK but globally, which might see some strain put on the company if they don't drop soon, or they indeed go up, which is not expected, but you never know what's going to happen. A big boat could block the Suez Canal and we could all end up in a bit of a nightmare again, but that's a different story. So what I think here is we've got a company that has a lot of positives going for it. There's a lot of activity in these mines. They're driving a lot of revenue, which is growing. We have this balance sheet net debt position, which is causing the PE ratio to sort of be suppressed slightly. And we also have this dividend position, which again is also causing the company to be suppressed slightly as well. So whether or not that impacts whether you buy it is up to you, but I think it's worth knowing that these things can be affecting the share price, and they might not necessarily go away just because other companies who are mining or in the gold industry are making our share prices are growing. So just because they're growing doesn't mean this will, because investors may be willing to invest in one company but not another in the industry because of these slight risks and red flags that we've already talked about. And that can be reflected here when you compare a company's PE ratio to others in its industry. So you've got other gold and resourcing companies here with much higher PE ratios. Again, in a nice range actually, that would be worth exploring more. So if you can see that this is the bottom of its peers, it's sort of saying to you, well, what is this doing differently, or what are the numbers showing me differently to what these companies are doing, because we're effectively all doing the same thing. So make sure you guys have warning signs when you see a PE ratio so low. The next part that I like to have a look at is the management and the ownership. So let's have a look at what the ownership's up to. guys, like I've said in previous videos, this is another key part. If you can get inside information, which is not illegal, that makes it sound worse than it is. If you can get public knowledge of insider transactions, which are transactions made by individuals close to the company, owners, CEOs, etc., and what they're up to, that can give you a real flavour of what the insiders are thinking is going to happen to the company. So if you've got a lot of share sales in the last 0 to 12 months, you can kind of get a flavour that something's not going to go right for the company in the future. It's not always the case, but it could be something like regulation coming in, earnings not being as expected, and a number of things that could affect the company's share price, which I might do a video on actually. Like I've said previously, it's not always indicative of a big red flag, but it can give you that flavour. It might just be the CEO shifted some shares because he needs to buy a new house, or he just wants to free up some cash. So looking at what the disposal is in proportion to their holding is absolutely key, guys. Let's have a look at what's actually happening here, what it's telling us. We've got quite a few purchases in October 23 from 3 individuals in the last 6 to 9 months, which are listed here. I think the biggest purchase here is 136,000 shares at 16 pence, made by Jacob Albertus Lutz. Shall we see who Jacob Albertus Lutz is? He is our CEO and executive director, and he owns 0.41% of the business, which amounts to £2 million in shares. So this is the CEO of the company has bought 136,000 shares, which roughly amounts to £21,000. So if someone's holding 2 million and they're only buying 20,000, that's a small percentage, 1% of their holding. So there's not much to get out of bed for, and I wouldn't say it was exactly something that you wanted to use as a clear indication that the price is going to skyrocket. However, it's a good sign that these individuals who are linked to the company closely are purchasing and not selling. So that's a good indication in my mind. What I do want to talk about is not necessarily this graph, but yeah, let's go back down to the P ratio, or actually let's keep it here. What we've got in the UK, especially at the moment, is a record equaling interest rate, certainly since I think it's about 16 years or something like that. It's at 5.25, set by the base of the Bank of England. What we have at the moment is a high interest rate, which is attractive to a lot of investors who are just keeping their assets in bank accounts or ISAs or wherever, and are happy to take that 5%. What I envisage happening, which is going into sort of the economic landscape behind UK exchanges, or especially in the AIM and actually the LSE as well, but what I envision happening is when that interest rate starts to drop, assets will be the safe haven for the wealthy. And I'm not talking about that you and your friends or me or myself. I don't consider myself in that wealthy sphere. I'm talking about the millionaires, the billionaires who have a significant amount of wealth and earn a significant passive income. And I see when the interest rates start to drop, they will use assets such as gold as their safe haven. So whilst this company might have a few red flags over it, and it's certainly not screaming buy right now to me personally, I do think there's a strong case to be made in the backdrop of interest rate changes, especially as a short-term play, to invest, if not in gold directly, but in companies that are mining gold, because I anticipate the price of gold to go up so significantly when that sort of change in interest rates to assets happens. So I think that's a very important thing to consider in your strategy here. We've got a few risks from the company in terms of dividends, and we can come on to this actually, but in terms of dividends being paid out to its shareholders and also its net debt position, yes, does that make it slightly risky from a long-term play? In my mind, yes, because it's got red flags. Red flags mean no go in my mind. But does it give you an opportunity in the short term, and does that fit with your portfolio? That's for you to decide. But in the backdrop of the economic climate, does the dividend payout matter so much if you time a purchase with the dates of the dividend payouts? And can you ride a wave of short-term gains when the interest rates start to drop and assets such as gold start to spike? Again, that's quite speculative, but I don't know what your portfolio is looking at. I'm just here to research this share and give you a few considerations. For me, this isn't a long-term play company. This is a company that, like I said, I could potentially put in my high-risk portfolio to ride a few percentages points and try and beat the banks when the interest rates start to drop or in advance of that. And as we know, we've got June assessment coming up for the interest rates, and if that stays stagnant, that could be an opportunity to jump in ahead of others on stocks involving gold and the mining and extraction of gold. Okay, let's just have a quick look at how it's been performing, because I think that's kind of what we're seeing now. We've got a 52-week high of 0.27. We're at 0.26, so it's nearly there, but you can see here since the start of the year, and as the year's progressed and interest rates have started to be discussed a bit more, and the market's starting to feel that those interest rates are going to drop, it's given people a little bit more opportunity to find a few companies or areas in stocks and shares or assets that will give them those gains that they're looking for to beat the interest rates that they're receiving on their money in current accounts and ISAs or whatever. Okay, so I hope that's helpful. I think in summary, like I said, we've highlighted a number of green flags. It's not all green flags. There are a number of red flags, which to me, keeping it simple, takes it out of the equation for a long-term portfolio play. Why I've highlighted this and will keep watching it and keep it in my watch list is because I think there is a short-term play with this. But again, that increases your risk, and it depends on what your risk tolerance is, and it depends on what your portfolio is looking like to whether it can accommodate something like this, because ultimately, guys, it's about making gains and it's not about gambling. So you can be wrong, and this might not go the way you expect, but I think there's a short-term play here potentially. So I hope you find it useful. If you have, please do subscribe. It's very useful to have your support, and I will link you the videos to ME Group International and Supreme, so you can see the other considerations that I take into account when valuing a share. So all the best, guys. I wish you all the best in your week of investing. Keep it simple, and I will catch you again soon.